and welcome to the Superb Diamond Range Show. This is episode 39, Investing in Index Funds and ETFs as part of the financial series. Welcome to the show, and we're going to be talking about investing. So investing can be done in an investment ISA after tax, or via a workplace pension or a sipp pre-tax. And I won't go into very much detail on this particular episode on the differences between using, say, an investment ISA or a workplace pension or a sipp, but I plan to do a future episode where I discuss the different vehicles that are out there. So firstly, we're going to start off with picking your investment. So first of all, you have to kind of talk to yourself or do your own research, maybe read some books on finance, visit forums to try and get a general idea of different types of investments that are out there. What a lot of people tend to do is usually have a mix of, say, stocks or bonds. Obviously stocks can be more volatile, but they can get you a higher return over the long term. Bonds tend to be a lot safer. But it's kind of good to have a blend of those. Obviously, there's many other things you can invest in. You can invest in gold. Gold is particularly good for like an inflation hedge or protection. You can also, rather than investing in physical property, you can invest in REITs, real estate investment trusts. So that's another idea. Me personally, I just invest in stocks and bonds, and I try to keep it as simple as possible in a two-fund portfolio. But when I first ever got into investing, I wanted to add lots of complexity and different fund choices together, but I've since kind of simplified it. Maybe go into that in a little bit more detail later on. Ultimately, you first pick off your investment that you're looking to use. The next thing, you would maybe go to a broker website, or you could maybe just go to Vanguard. And basically, if you go to Vanguard, obviously it will just be Vanguard funds. If you go to a broker, you might have a wider range. So you could have options in, say, Fidelity, BlackRock, that kind of thing. Ultimately, the two most popular types are index funds and ETFs. ETFs have gained a lot of popularity recently, and they are very, very good. I started off investing in index funds because a lot of the reading I was doing was based in America, and they always talked about investing in things like VTSAX, the Vanguard Total Stock Market in America. Obviously, being based in the UK, kind of had to change, what I was kind of, looking to invest in, because obviously I live in a different country and there's different, ways to invest depending on where you live. I'm a big fan of investing globally, so I tend to pick global trackers that are market weighted, and they kind of, let's say the biggest country that I own would be probably America, but obviously because it's market weighted, if that ever changed and one day it became China or one of the emerging markets which are in there as well, like Brazil or India, they could garner a bigger percentage, and be so basically the allocations are changing as time goes by depending on how the global economy is doing. So that's what I'm a big fan of. But of course, you can just pick particular countries that you think are going to do well. So if you're a big believer in, for example, Japan, maybe even the UK, but obviously some people at the moment are a bit unsure with the UK with the whole Brexit situation. So it really is a case of just trying to figure out, where you want to invest. And my take on it is that obviously if you're globally diversified, if you're picking countries all around the world, as opposed to one country. So, for example, I live in Scotland, in the UK. I could go out and get the FTSE 100, which is the top 100 UK companies. In America, the equivalent of that would be the S&P 500, the top 500 American companies. And, if I believe that they were going to do really well, I could just sort of invest in those countries, the US or the UK. Bearing in mind that the FTSE 100 and the FTSE 500, the companies within are global companies. So obviously, the UK FTSE 100 has Diageo in it, has Vodafone, Shell, that kind of thing. So there's a lot of companies that have global reach. So they will do quite well. But obviously the technology sector at the moment is doing really well, and quite a lot of the tech companies are based in the United States. So therefore, they're quite well resembled in the worldwide funds, basically. The next thing you want to think about is obviously diversification. So obviously you have the choice of just putting everything into stocks, or you could have a mix of stocks and bonds, or you could have a mix of maybe gold, REITs, that kind of thing. So that allows you to diversify. I mean, you could also get government bonds with a mix of corporate bonds. You could, get different types of stocks that you want to choose. Diversification's good because obviously if you put, as the old saying goes, you put all your eggs into one basket, chances are it's a bit risky to put everything into one place. So yeah, I think that it's important to be diversified. So that's I like to have two funds in that scenario, because it also gives you a bit of ammunition as well, because obviously the old saying, buy low, sell high, basically allows you to basically when stocks have gone down in price and your bonds have gone up, you can sell bonds to buy stocks, or if your stocks go up crazily and you want to sell the stocks to then buy more bonds to keep your allocation. So your allocation could be 50-50. So you might have 50% in stocks, 50% in bonds. Therefore, if your stocks went up to 60% and then your bonds were at 40, just to keep your allocation back to how you originally intended at 50-50, you could sell, say 10% of the stocks, and then buy some bonds to bring it back into balance. So it's 50-50 again. Things like asset allocation, I mean, there's been different types of portfolios over the years. One that I've always been quite interested in, or, one that I liked was the permanent portfolio, which, is invested in 4 asset classes, cash, gold, long-term bonds, and stocks, basically, within the country that you're from. And basically that is a very good portfolio because obviously they all can move in different directions, and they're all uncorrelated. So they kind of, well, one might not be doing so well, the other one will, and so you're always doing quite well. They call it like an all-weather portfolio. Ray Dalio's got a one similar, but the original sort of a Harry Brown one was more simple, but did the same idea. I do like the idea of that portfolio. I just sometimes get put off by having so much of the portfolio in cash and so much of it in gold. While I'll admit that cash is a good thing to have on hand if there's like a market crash, obviously you can turn cash into any investment, so it is quite good for that. Obviously gold will have its time, when sometimes gold can do really well, but obviously it doesn't pay you like a dividend. It just kind of goes up in value. But it does have protections for like inflation. So if you think that inflation is going to be really bad, it might be worth owning some gold. Some people say even just starting off with maybe 10% gold. But obviously the permanent portfolio holds 25%. So basically there's a few other ways you can invest. You can lump sum invest. So if you had a big lump of money that you'd saved, or a bonus from work, for example, you could just plow that in as a lump sum investment. What a lot of other people do is, particularly through a workplace pension or a 401k in America, you could invest monthly via dollar-pound cost averaging. This allows you to obviously buy at different times in the market cycle. So, you could be buying when it's low some months, high when it's other. But, obviously you're getting a good variety of the price going up, price going down. If there's obviously a crash and you continue to invest, you're investing in a sale, so you'll get everything cheaper. So that's quite good as well. If I was asked if I did have a lump sum, would I be better off putting the lump sum in versus, slowly drip feeding it into the market by pound or dollar cost averaging? I would argue that you're better off just putting the lump sum straight in regardless, because I don't believe in market timing. To me, what's more important is timing the market versus timing the market. So to me, it's like, get it in there, let it work away, it'll do its thing, and, just try not to mess with it too much. Obviously, that's another thing about investing is behaviour. Sometimes if you basically keep reading blogs about finance, keep reading books, talk to people that invest, it can give you different types of ideas, and it starts to make you question your choices. So you might think, oh, I need to get some gold. So you go out and get some gold. Oh no, I might need to get, lower my bonds, or, higher my bonds, because some people say I've got too much for my age, or I should be more, protect myself more, that kind of thing. So you need to kind of be aware of that if you do sort of have a plan for how you want to invest, sometimes it's a good idea to write yourself a letter and, try not to watch your portfolio very often. Some people will do it every day, which is, really tough, because obviously it can go up and down daily, and it can be, make you feel really bad whenever it keeps going down. I would recommend maybe checking in every 6 months to a year, just not too often. You could probably do it monthly if you were really keen, but definitely not daily. Because again, that leads to bad decisions, because you might think, this isn't performing very well, I need to change it. But if you'd have just left it in over the year, it would have done quite well, or over a few years. So you've always got to be aware of that. The other thing I would say is always try to invest inside a tax-sheltered vehicle. So when I say this in the UK, I usually refer that to, putting the money through the pension system or through a sipp. Also ISAs, because obviously you get an allowance for the year that you can invest in an ISA, and any money you put into the ISA, any interest it makes is tax free. So that's the way that you need to be doing it. Obviously you just, you don't want to have a headache of tax. There's a big debate regarding pensions versus ISAs. Again, I think I'm going to make a separate episode on pensions and ISAs, but to me, pensions lock your money away for a long time, and they are a very disciplined way of saving. But also, if you have a workplace pension, what I would always recommend is always take advantage of the employer match. After all, it's free money. And, after you get your match, you could, if you wanted to, put a bit more into the pension, but you could also just open up an ISA and just put extra money into that. And that gives you a bit of flexibility because you'll still be invested. But one of the main things about pensions is we don't really know where the tax rates will be when we retire. So obviously, if we put way too much into the pension, we don't know if, the tax rates are going to be quite high by the time we retire. So by sort of putting in a mix, say some into the pension, some into the ISA, you'll have some money that's going to be taxed at a later date in your pension, and some money that will be taxed, won't be taxed when you retire in the money that you build up through the ISA. So I think a combination of the both, I like the idea of maybe putting in up to the match. Obviously at work, some workplaces have things like salary sacrifice. So that can give you an incentive to maybe put a bit more into your pension. Sometimes the options within a workplace pension aren't the best either, and they're quite expensive, the plans. So some people might prefer to just put it in an ISA because they've got more investment options, or even opening up a sipp separately and putting money into that. Because that's another thing that I've noticed. A lot of people that may have old jobs that have built up separate pension pots. It might be a worthwhile idea putting that into a sipp, because that would be a good way to, keep all the money together, and so you don't have to go around chasing all these pension companies when you retire. So you kind of know where all your money is, and also you can put it into a low-cost index fund with the likes of Vanguard or even BlackRock. I must say I'm a huge fan of Vanguard. I think that I like the ethos of the company. I'm a big fan of Jack Bogle. Rest in peace. And, I just like that company. So me personally, I only invest in Vanguard. But, I would be open to the likes of BlackRock or Fidelity if I found that they're, offering something that was better or cheaper. But generally, I just like to stick to Vanguard because it's a company that I feel quite good about, and it's highly recommended in the finance world. Obviously, for sort of my investing strategy, I tend to pretty much invest in a global index tracker. So the one that I personally use is VWRL. It's a Vanguard one. It's the Vanguard All World. It's a really, really great fund. It's an ETF as well. I also invest in VGov, which is like government bonds, intermediate government bonds, I believe. And that's another, and I just pair the two together. So I have my pot A, which is basically, stocks which will be invested in companies, and, the better the companies do, the more money it builds. And then obviously for the safety side of things, I invest in government bonds because it's one of the lowest risk assets that you can have. It's maybe not as volatile as the likes of property or gold. So I feel that you can have, a machine that makes a lot of money through the stocks. And then obviously, the bonds are there like the brakes of a fast car. They're there to kind of help you in, difficult times. Recommended reading, I would say, for me, I read a book called Fail-Safe Investing by Harry Brown, which again talks about the permanent portfolio, invested in gold, long-term bonds, stocks, and cash. And that is a very, very good book. It talks about, being wise. He talks about having a speculation account as well. So, to have a permanent portfolio that you stick to, that you never touch. But obviously, if you wanted to have play money, you could, invest in other things. So that's quite an interesting book, but it kind of tells you to basically set up something safe and don't, mess around with it too much, and it will serve you really well. Obviously there's Simple Path to Wealth book by Jim Collins, and also the Stock Series blog by Jim Collins. Really, really good, the Stock Series blog. It's quite a few pages, but very, very interesting. And also to read the comments as well is really good. Obviously, Simple Path to Wealth book by Jim Collins is really interesting because he talks about what he refers to as the accumulation stage and the preservation stage. So the accumulation stage is when you're, in your working days, you basically put majority of your money into 100% stocks. And then obviously when you get nearer to retirement, say 10 years out, 5 years out, you start to buy some bonds to add a bit of stabilization to your portfolio. So the idea is that you invest in stocks because they generally do quite well over the long term. And even if it's a crash, just to sort of, get through it and keep pumping money into it. And eventually you'll do quite well. I do like the idea behind that. But I felt more drawn to a strategy that by a Danish guy called Lars Kroijer. He wrote a book called Investing Demysified, and has a really good YouTube series as well, that he explains this sort of strategy. And it's basically the one that I've kind of been talking about, where you basically invest in a global index tracker and then you invest in a government bonds. So I'm a big fan of Lars Kroijer, obviously Jack Bogle, Harry Brown, Jim Collins as well. They're sort of like my investment heroes, I guess. But one thing I will say is that anybody can invest, and even if it's a small amount, it will add up to something decent. So the important thing is to obviously start investing. And I'll just put a disclaimer out. Obviously, what I'm doing with my money is me personally, but what you do is completely up to yourself. But I advise maybe speaking to a financial advisor, or doing a bit more research to try and figure out what you'd like to do. But ultimately, this podcast is just like, information and knowledge. And if anybody has any other suggestions of ways to invest or any ideas, please feel free to email me or leave some comments. We've obviously got the YouTube channel, the podcast itself. There's also a Twitter page, which is at Superb Diamond RA or Superb Diamond Ra. Thank you very much for listening, and I hope you're enjoying the financial series. Hope to be back soon to do some more talk about, things like pensions, ISAs, that kind of thing. And hopefully get some interviews as well with some interesting people. But once again, thank you very much for listening, and peace out.